Many. Tom Donlan has made the trip. You read him in Barron's every weekend, and if you don't read him in Barron's, well, I would recommend to start at once. I'll let Tom introduce his panel, and we're going to talk about banks.
Thank you, Dave. I believe that the moderator who moderates best, who moderates least. So I will give you only a moment to tell you that we've changed the order from your program, and that our first speaker will be Steve Sexauer.
So can you hear me okay? So my story is a scare story, and it's a story of a too big to govern part of the economy, and it broke the system. And when the system broke, it just rained carnage on us, from trillions in lost output, just devastating unemployment, and now endless QEs that are just fraught with danger, and we don't know how they'll end. So I'll tell you how it ends, and then we'll go through the story. It ends by me telling you we did it to ourselves, all of us. And I'm going to try and make the point that we didn't follow one of the most basic lessons in economics, and that incentives matter, and they matter a lot. So that's the title of my talk. And we also didn't listen when people like Harvey spoke up back then and said, Houston, we have a policy problem here. We just didn't act on it. So let me give you my frame of reference when I do the Fannie Mae, Freddie Mac countrywide story. Is my prior life, I was a large cap equity institutional portfolio manager. So I toiled away studying these companies, buying them, selling them, going to analyst meetings, going to private dinners. And when I looked at these companies, they weren't like Ming the Merciless. I couldn't go through the people and say they're evil or they're bad. Maybe some seem smarter than others, but they just weren't bad. But I go, how could this catastrophe have occurred that we're still dealing with? It's 2012, and we're still dealing with the aftermath. So I'm going to go through very rapidly, because it's just a story in pictures, the story, and then I'll stop for a moment, amplify the conclusion, and then I'm going to turn it over to Harvey. So what this is, and I'm going to just stand here to help you, it's the scale that you care about. This is nominal GDP in the US from 1990 to 2007. It got 2.4 times bigger. It grew about 5%. The scale is important because watch this. This is household mortgage debt. It got 3.8 times bigger. There's some reasons for that. One is incentives. We changed the tax structure, so you took out a mortgage, you didn't take out a credit card loan. People cashed out of their mortgage, their home equity, and we kind of incented people to get in. But here's the real story. That's Fannie Mae and Freddie Mac. So I'm going to read the numbers twice, because when I saw them, I thought I calculated them wrong the first time. From 1990, they reinsure mortgages. You read the original act to create liquidity. They weren't supposed to be banks that eat the whole economy, right? And carry companies. They're just kind of, they're supposed to support the mortgage market. Their balance sheets ended up being 11 times bigger. You'd almost have to be the Google of mortgages to grow that much faster when the entire economy is only growing this much. Something is going on here. I have a red line on top. That's countrywide, added to Fannie Mae and Freddie Mac. So the top line is Fannie, Freddie, and countrywide, all the assets on their balance sheet. Countrywide was this little company, always capital constrained, very aggressive. It was like the Costco and Walmart efficiency. And all of a sudden, it explodes in size. You can see it keeps growing after accounting fraud puts limits on Fannie and Freddie. And just to put this in complete perspective, 98 to 2000, a government-sponsored entity, its chairman made $90 million. Why? Because it is raining money on Fannie and Freddie as their balance sheet grows. That's perfectly legal to make money if you're incented to do it. Countrywide, on the other hand, takes off when Fannie and Freddie can no longer build their balance sheet and we're still in a housing boom. So let's keep going. I call this government-sponsored lunacy. So watch this. These are like normal, conventional mortgages. You show up, you make a down payment, you make your payments, you pay off your mortgage, the world works, they go into ABS. People buy the asset-backed securities in different tranches. People like me when I'm younger, I didn't actually do this, but people like me would try and go figure out the prepayment rates and bet and everything. That drops from 63% to in the 30s. What went up? I'll tell you what went up. Subprime and Alt-A. So something's happening where we've created this environment like lend to people that typically could not get a mortgage. That's subprime and Alt-A. And it went up a lot. But where did this come from? In 1992, there was a law, I actually want to not misstate the name of it, so I wrote it down, called the Federal Housing Enterprise Financial Safety and Soundness Act. It's worth repeating that. The Financial Housing Enterprise Financial Safety and Soundness Act. And it created the HUD Office of Federal Enterprise Oversight. You know what they said? They said it gives the Secretary of the U.S. Department of Housing and Urban Development the authority to establish low and moderate income, underserved, and special affordable housing goals for whom? Fannie Mae and Freddie Mac. So if you just go back, not surprising, what did they do? They went to people in subprime space. And not surprising, they grew like a weed. So, they even brag about it in the 2001 annual report. Here's the goal, 50% of the units have to go to low and moderate income housing, and we got to 51.6 actually. So not only did they do it, they're bragging about doing what? What we told them to do when we voted the law. Now, what did the rest of the banks do? With all due respect to bankers, I kind of worked in a bank. We're smart, we're not all that smart. We're like lemmings. So here is a list of 2005 of all the mortgage banks that were into this subprime space. Why were they in subprime space? I'll tell you. You made a 1% margin on a regular mortgage, and you made 400 basis points of 4% on a subprime. Incentives matter. Who's going to underwrite a normal mortgage if you can make 4 times that in a subprime? I'm going to read some names because most of them don't exist. AmeriQuest, New Century, Countrywide are the top 3. Wells Fargo did survive. Option 1 Mortgage, Fremont Investment. I was at a conference in 06. So you go to the conference, they talk to you. And I'm sitting with the CFO of one of these companies, who will go unnamed. I said, I don't get it. How are you funding your balance sheet? He says, I have all these securities I can buy. I go, I know you can buy them. How are you funding it? He says, the repo market's open to me all day long. I go, well, what if it closes? Oh, it'll never close. We got the best. And like a year later, gone. He's gone, the company's gone. Why? Because their assets weren't that good and the repo market died, and so did their company. Subprime mortgages were 22 of all originations that year. So we'll probably kind of go to the next part of this story. I just want you to think, that's ground zero. We blew ourselves up with subprime because that's what the government said we should do. So we did. So this little company that everybody's saying they were so evil and Mozilla was such a bad guy. I mean, this is a little company that could barely get enough capital to grow, and all of a sudden it grows its balance sheet 25 times. How do you grow your balance sheet 25 times? Where do you fund it? I can have assets, but I have to issue debt, equity. So, I'm kind of an old-fashioned analyst, so I said, how did they fund that? Well, it's inconceivable. See the yellow? Anybody know what FHLB stands for? The Federal Home Loan Bank, in this case of Atlanta. So Countrywide went and they formed a bank, and they got supervised by the Federal Home Loan Bank of Atlanta because they thought that'd be a good place to be supervised by. Maybe they needed money. 27% of all the mortgages that eventually blew up the world were funded by the Federal Home Bank of Atlanta. You can't make this stuff up. And then they did have deposits. They did have some others. So basically, we have ourselves funding Countrywide to go take us over a cliff. And it was all perfectly legal and perfectly encouraged. So now we have the beginning of the end. I want to go to 2007 because that's really the beginning of the end. A bank basically, banks in Germany bought this stuff, and other people bought this stuff, and all of a sudden they found it was worthless, and all of a sudden we're getting headlines that say, you can't get your money back from an asset management firm because, and I still have some of the quotes, we don't know how to value our assets. How can this be? We can, or they're not worth anything. And then, of course, I have the Wall Street Journal headline, the jittery home mortgage lenders cut off credit. So now it hit the real side of the economy. Well, wait a minute. I'm broke, I have no credit, you can't have it either. So this is, by 2007, it hit the real side of the economy. And so now, what do? We search for villains. I really thought about that, like, was it the bankers? Bear Stearns, Lehman, Countrywide, JP Morgan, Jimmy Kane, Fold. I don't think they were the villains. They were just aggressively pursuing the normal incentives you need in a capitalist system of profits, and we created all of the incentives, and we supervised them. In the case of Federal Home Loan Bank of Atlanta, we shoveled money at them. How about the rating agencies? Well, they were being paid on both sides, but I will tell you, as one of the adults on the other side of it, we all knew. We just wanted their models. They gave us their models, we played with their models. And we kind of knew. Was it Congress? They wrote the laws, Dodd and Frank et al. I really think it was us, because we let it happen. We wrote the laws, and this is kind of going to be a lead-in, because I'm a big champion. What Harvey's going to go through is, we wrote the law in '92, and we let HUD do this year after year. Go do this. And I love this headline from 1999. Fannie Mae, the nation's biggest underwriter of home mortgages, has been under increasing pressure from whom? The Clinton administration to do what? Expand mortgage loans among whom? Low and moderate income people. Read subprime all day. And at the same time feel pressure from stockholders to maintain that vertical growth curve. So what did they do? They did exactly that. They expanded their balance sheets, and they did it aggressively, and they met the law, and they took us right over a cliff. So here's my conclusion. Incentives really matter, and they matter a lot. And sometimes those really boring introductory or middle-level economics courses you take, they're probably the most important. These microeconomic incentives, when you get them wrong, can devastate the world. I have one postscript, and my postscript is, never attribute malice to that which is adequately explained by stupidity. And with that,
Thank you, Steve. That appalling tale, which we've heard before but rarely so succinctly and clearly, is also the lead-in to a talk about the past and the future from Harvey Rosenblum with the Dallas Fed.
Let's see if I can get the slides to work. Okay, let me go back. Get the title slide up. Good afternoon. I've got the difficult task of speaking after a heavy lunch with fantastic desserts and trying to keep everybody from nodding off. It's not an easy task. I normally never give dinner talks anymore because when I do, I find that it's very, very difficult to wake up the audience when I'm done. And I had an experience in which a fellow came up to me after my dinner talk, and he said, you and I are in the same business. And I said, oh, are you an economist too? He says, no, I'm an anesthesiologist. And then he added, just for good measure, at least he knew how to wake them up when he was done. So I'm going to try to keep you awake, and maybe I'll keep you awake for the wrong reasons, and I'll put nightmares in your mind. But the first thing I have to do is give a disclaimer for my talk. The views are my own and those of my colleague, Liz Organ, who's worked on this presentation with me, and not should not be construed as the views of anybody else in the Federal Reserve System. Believe it or not, I was once young and impressionable before I became old and cynical. And back in 1967, I saw a movie titled Cool Hand Luke, starring Paul Newman. I won't go into the details of the movie, but what's important is that out of that movie comes the 11th most frequent quote from the list of the 100 best movie quotes. What we have is a failure to communicate, and that's the theme of what I want to talk about. And it kind of fits in, I think, with some of the things that were said this morning about quantitative easing and the Fed's efforts to communicate its policy. But I'm going to get off of monetary policy for the most part and really talk about another part of policy that the Federal Reserve is intimately involved in, and that's regulatory policy and supervisory policy for the banking and financial system. After the financial crisis, Dave Wessel wrote a book called In Fed We Trust, and early on in that book, he quotes then New York Fed President Tim Geithner as saying that in the midst of a crisis, communication is very important. You have to get the substance, that is, the policy right on what you're doing in intervening in the financial sector, but you also have to get the theater right, the communication. And one of the major themes of Wessel's book is that the Treasury and the Federal Reserve really muffed the theater. They never quite explained what they had done, why they had done it, what they might do next, and they left it up to folks like David Wessel and the other people in the media or in politics to spin the story any way that they so chose, and so the Federal Reserve was not communicating. The Federal Reserve has put an enormous, where did I just go? Oh, okay, I just was looking at something else here. And to emphasize that it's not just Dave Wessel who says this, former Fed Governor Larry Meyer says that what the Fed says is often more important than what it does because the Fed moves markets. My corollary of that is silence speaks too, and silence often will speak even more loudly than the actions or the words. And now let me turn to the words. The Fed has, since 1994, been putting out a statement after each FOMC meeting. Actually, it's only since 1999 that it's after each Federal Reserve meeting that the FOMC meeting that the Fed puts out a statement. But the length of those statements has risen dramatically in the last few years. The last few statements by the FOMC are running close to 700 words. And the issue is, are more words necessarily conveying more understanding or not? This has something to do with monetary policy, which was the focus this morning, but I really want to get at the other aspect, which is in the financial crisis, the Fed almost never spoke, or when it did speak, it was weeks later. And in theory, monetary policy and regulatory policy are separate. In practice, I think they are both the same policy made by mostly the same people trying to accomplish macroeconomic goals. So they're very much the same, and both require clear communication. If I can explain it another way, before 1994, the Fed never really said much about monetary policy and let the markets infer what it was doing. The be-all and end-all of quotes on this comes from not the Fed, but from Montague Norman, who was the governor of the Bank of England back in the 1920s, 1930s, and early 1940s. His motto was, never explain, never excuse. I take that as a caricature of what the Fed does with regulatory and supervisory policy now. By caricature, I mean it's half truth and half exaggeration. It's like a cartoon, but I'm saying that to make a very, very strong point. One way I can relate this to you is if we look at conventional monetary policy diagrams of how monetary policy is supposed to work. You know, the Fed lowers the Fed funds rate, and it's supposed to do all these magical things with lowering short-term market rates and go through the usual mechanisms of monetary policy. And that's the way the Fed always thinks of it. But what we learned in the financial crisis, and what I think Paul McCulley was reminding us of before lunch, is monetary policy doesn't always work in the way the models tell us it will. If you don't have a well-capitalized banking system and you don't have business confidence, monetary policy is not going to work very well. And this is conventional monetary policy. But if we look at unconventional monetary policy, where they're doing large-scale asset purchases, which, by the way, work the same as conventional monetary policy, it's really no different. It's the same mechanisms. Again, without a banking system that is functioning well in a predictable manner, monetary policy, whether we're looking at conventional or unconventional monetary policy, is going to be stymied. Okay? But I want to kind of go back to the Fed's role as more than just monetary policy, particularly since the Dodd-Frank Act was passed in 2010, otherwise known as the Wall Street Reform Act. I want to explain here that in the period leading up to the financial crisis, this is again a chart version of what Paul McCulley was talking about earlier. I've highlighted a yellow section there, which is 2002 to 2005, as the housing bubble was building up. And the Federal Reserve had an unusually easy monetary policy. The Fed funds rate over that period averaged less than 2%. During that period of time, you would think that there would have been some voices in the room that would have been saying, well, watch out, we have a housing bubble forming here. The reality is, during that period, there were only 4 dissents from the otherwise unanimous monetary policy decisions, most of which were for lowering rates for most of that period of time, number one. And those 4 dissents were by people who wanted an even easier monetary policy than what the majority was voting on. Now, if you think I'm standing up here trying to criticize the Fed that they held interest rates too low for too long and I'm smarter than everybody else, let me just say I was in the room for every one of those Federal Open Market Committee meetings. I had an opportunity. I couldn't really stand up and say, Mr. Chairman, I think you're leading us in the wrong direction. I couldn't do that. They'd carry me out of the room if I were to have done that. I'm not a policy maker. I'm a policy advisor. But I had ample opportunity to talk to all the people in that room and say, I think we're going down the wrong path. And I never once spoke up because there was nothing in my life experience that told me that the policy was wrong or that it would end up with the disaster that we had. So, but remember, the Federal Reserve is now charged with financial stability, and this is looking at their past record with financial stability. And the question I raise is, can we expect better of the FOMC in the future? Number one, and number two, now that we have something called the FSOC, the Financial Stability Oversight Council, with 15 regulators across Washington and other parts of the United States, will they do a better job? My short answer is no. Having said that, let's look at what was the result of that crisis that we had. What this chart shows is how far we are as a country below the average recovery. And our recovery, of course, now is running into roughly 5 years long. We're 11% below where the average recovery is. That's one measure of the cost of the crisis and getting it wrong. Okay? Another way of thinking about it is getting back to this business that monetary and regulatory policies are not independent. What the Federal Reserve does with regulatory policy is going to be just as important whether we get out of this situation. I'm going to repeat a chart that was used this morning by Mr. Duncan, looking at people's expectations of future income. And what this chart shows is that before the crisis, more people, for actually not just before the crisis, since the late 60s, more people thought their income would rise than people thought their income would fall. Beginning with the crisis, and since then, we've seen a dramatic change in the sense that more people think their incomes are going to decline in the future. That's sort of my shorthand way of getting to Milton Friedman's permanent income hypothesis. If you think your income in the future is going to be lower than it has been in the past, you're going to consume a heck of a lot less. And that's what comes up with my estimates of the cost of the financial crisis. We could do it in GDP, we can do it in consumption, we can do it a lot of ways. I've just published a paper on this. Bottom line, if we look at consumption, we're looking at the loss of possibly as much as 2 years' worth of consumption in the future as a result of this crisis, what Paul McCulley again referred to as the hangover from what happened. If we put it in terms of GDP, it's 1 year of output down the drain. Okay? Either way, it was a very, very costly crisis. One way of thinking about it, if you want to get away from numbers, is this cover of the Economist magazine. I wanted to put it in my presentation, but Liz assured me I'd be breaking all the copyright laws, and I need to be very sensitive to that. And what this Economist magazine from 2 weeks ago shows on the cover is a lion, a king of beasts, standing over a map of Syria, and it's called the Weakened West. It's not just the United States, it's all the Western powers. But in front of that lion is a glass of water with the lion's teeth in it. It's now a toothless lion. And that's my metaphor for the cost of the crisis. The United States cannot do what we used to do in policing the world because the cost of the crisis basically left us dead broke without the resources to continue to do what we've done in the past. So it's a metaphor, but I think it's a very powerful one. So the issue is what broke the bank and what is going to continue to break the bank. And this is where I'll use a quote from my boss, Richard Fisher, and myself in an op-ed piece we had in the Dallas Morning News recently. The largest financial institutions are a dagger pointed at the heart of our economy. And if I think about what this means, and I want to relate it to you, I want you to think of a business model in which the businesses running themselves base their whole business model on the fact that they have a safety net under them so that if they make some investment decisions and they pay off, everybody in the company does well. But if those investment decisions do very poorly, the taxpayer has to pick up the burden. There aren't that many companies in our economy that run on that kind of a business model. But those institutions, those financial institutions that we typically label as being too big to fail are the ones that practice that business model. In the words of Steve Sexauer, incentives matter, and incentives matter a lot. And if you have perverse incentives, you are likely to get perverse outcomes unless you begin to change those incentives. So that's where I'm trying to go next. So we have a subsidy there, and a subsidy once given is almost impossible to remove, and that too big to fail subsidy is very, very large. Dodd-Frank tries to remove those subsidies through smart regulation or smarter regulation. It's a worthy goal, but again, it's going to be difficult to achieve. And I just want to keep coming back to this business of some subsidy once put in there is very, very difficult to remove. And one of the reasons it's so difficult to remove it in banking is special for a number of reasons, but we have public policy that makes banks special. One of those is the largest banks are almost impossible to have a hostile takeover of them because it would require regulatory approval, and it's not likely to be forthcoming. Banks are special. Here's a list of all the reasons why banks are special. I don't have time to go into it. But I want to talk about how public policy has made super large banks even more super special during and since the financial crisis. Basically, we have a triage regime in which the first responders, the Fed and the Treasury, are going to come in and save the biggest banks first and leave everybody else to fend for themselves. They've been given, some of the biggest ones have been given an escape hatch. They weren't even banks at all, and they were allowed to become bank holding companies. And now, with the Dodd-Frank Act, they are labeled SIFI, systemically important financial institutions. In Washington, they pronounce them SIFIs. In Dallas, we pronounce it sci-fi. It's like something out of science fiction. It guarantees that they will be deemed by their creditors and their owners and their stakeholders to be too big to fail or systemically important, because that's the power of the label that they are given. The market has been trying to tell the leaders of these companies that something is amiss here. What this chart shows is the price to book value for 5 very large, very complex bank holding companies. They're listed there. For the red line, I can't read it without my glasses very well, but JP Morgan, Citigroup, Goldman Sachs, Morgan Stanley are 4 of them. Then we have 5 very large, but very much less complex bank holding companies. And they've been trading at a premium to book value consistently and a premium over the large complex holding companies. For several years, up until just a few months ago, many of these large complex holding companies were trading at less than book value. And that's the market's way of saying the parts are worth more than the whole. Mr. Leaders of these companies, please break them up. You'll be doing your shareholders a favor. But it just doesn't seem to want to happen. Again, the too big to fail subsidy, I think, is what is driving this. So the issue is, I don't want to go into the virtues of community banks and small banks, except they do know their customer. But I do want to talk about how lopsided a system is and why I think this issue is a little easier to address than seems so on the surface. When we think of who these too big to fail banks are, there's probably fewer than a dozen of them. Fewer than a dozen institutions that really have to be focused on. There are only 0.2% of all banking institutions. Less than 0.2% of all banking institutions are the source of the problem, and the other 99.8% are not the source of the problem. So when I stop and think about that issue and how do we address it, I come back to the fact that we need to perhaps encourage the leaders of these institutions to do what the market is telling them. So Richard Fisher and I have come up with something we call the Dallas Fed Plan, in which we would simply limit the safety net protection to traditional commercial banks and literally take it away from every other non-bank part of the bank holding company. Get the incentives right. In fact, in order to reinforce those incentives, get every creditor of every part of that holding company to acknowledge a simple two-sentence statement: yes, I understand I can lose money, my funds are at risk, I get it, okay? That reinforces those incentives I mentioned before by moving the safety net to where it was always intended to be. And if that's not enough, then the management and leaders, boards of directors of those fewer than a dozen institutions need a little bit of a push in the right direction to reorganize their companies, just like the market is trying to tell them, so that the banking part of their entities, there is no bank left that is too big to fail. Every bank that is left in the United States is now too small to save and would be certified by the FDIC that, yes, it's too small to save. The FDIC has been in the bank closure business for 80 years, and they know what is too small to save, and they close those banks. In on Friday, out on Monday is their operating rule, and it could be done for the giants as well. Now, the issue is the market already moving in that direction? And the short answer is yes. Some of the large bank holding companies have already begun to do spin-offs. I mentioned two of them here. They're not alone. I'll mention one that comes from outside the United States that has now declared that some banks have begun to exit businesses that are causing reputational risk or are ethically problematic. I love that phrase, ethically problematic. But the bank in question here, HSBC, is the one who's declared that this was the direction they wanted to go. A Wall Street Journal article just 2 days ago about one of the other large holding companies in the United States, in fact, it's the biggest one in the United States, I won't mention it, they've also begun to change what they're doing, and the motto now is know your customer and know your customer a lot better. Get out of these ethically problematic businesses. So it's beginning to happen, but it's happening very, very slowly. The importance of what this means, particularly at a conference like this, and I'm going to connect monetary policy and regulatory policy right here. When we stop and think about the money supply that we talk about, that the Federal Reserve supposedly has some monopoly power over, the Federal Reserve doesn't have monopoly power over that money supply. 90% of our nation's money supply is created and held by the for-profit sector of the banking system, mostly called commercial banks. 90% of our money supply is in the hands of the banking industry. And if we stop and think about our currency, which is a fiat currency here in the United States, our money supply, it's a faith-based currency. No faith in the currency, there's a run on the dollar. And that is the connection between the regulatory policy and the monetary policy. If people lose faith in the banking system, they're going to lose faith in the dollar and faith in the U.S. economy, and that's going to undermine the operation of our system. So where do we go from here? I think a suggested restructuring solution for these banks is about proportional to the cost that those banks imposed on our economy in the last crisis. 1 year of output down the drain. Do we want to go through that again? Half measures will not get us where we want to go. It will not be a credible regime shift. And again, if half the people in the United States think that too big to fail has not been addressed, and another half think it has been addressed, we still have to look at how that half that believe that too big to fail is still the going policy in the country are going to behave and what that means to the largest banks. 2 minutes? Okay. So, writing about the Dodd-Frank Act a couple of years ago, I said what needed to be done was to simplify it and codify it quickly. That has not been done, and as a result, the rules are unenforceable. So if we want to think of where this communication policy comes in, it's part of this adverse feedback loop. If people believe that banks are too big to fail, those banks will grow faster than others. Their cost of accessing funds will be cheaper than others in the repo market or wherever, and that circle is going to keep going, allowing them to get bigger and bigger relative to their smaller and smaller competitors. Okay? So the only way to break that adverse feedback loop is going to be with better communication and a credible regime shift. Credible, believable, where the largest too big to fail banks are going to be suggested. Again, take away the safety net from the non-banks, get their customers to sign an agreement saying, yes, I get it, and then if that is not producing the results that are needed, then some kind of scaling back of the size and complexity of these companies is going to have to become part of government policy. So my conclusion is this is where we need to go. We have to have a credible regime shift. If we don't, the cost of the last crisis is probably going to pale in insignificance to the cost of the next crisis. So getting the communication right, that yes, too big to fail has ended. It cannot be ended just by using the words, we've ended too big to fail. There has to be some credible action that will change the regime, change the behaviors of the creditors of these institutions and the institutions themselves. And until that is done, then we have this Damocles sword hanging over our head and hoping that monetary policy can avoid some of the oversteps that were talked about this morning with the obvious implications for financial stability, maybe hoping for too much. Thank you.
At some of those Fed meetings, and I know he had a strong and illustrious career, but if more people had heard it sooner, we might not be hearing about how we're going to have to muddle through after all. And with that, I give you Don Rissmiller.
Thank you, Tom, and thanks to the CFA Society and GIC and David and everyone for putting on this event. So I'm here to take a slightly different tact on this topic, but with a similar end conclusion, which, consistent with the other speakers today, is that incentives do matter. So picking up on that idea that incentives matter, what I want to talk about is why we need the financial regulatory structure to solidify in the near term. My view would be that we're at an inflection point in the U.S. economy, and the urgency with which we need to codify some of these financial regulatory items is increasing. The reason simply that I would give you that I think we're at an inflection point is that in my role, I get to talk to a lot of people, talk to a lot of institutional investors in the course of any given week. And over the last few months, the questions that I get have changed a lot. So over the last several years, generally the questions were all about what can go wrong. So is the euro as a currency going to survive? Is China going to have a hard landing? Is the U.S. fiscal cliff going to be an issue? Is what's going on in Washington right now going to be an issue? Is a spike in oil prices going to be an issue? But recently, a lot of those have calmed down. They've calmed down for what I would say are good reasons, meaning even if everything is not fixed, there's a sense in which there is some containment. And so for the China hard landing story, Kathleen talked earlier about how that's a tougher case to make. Look at the Purchasing Managers Index. It's back up above 50. For the Euro crisis, we had a stress test of sorts earlier this year when we had some events in Cyprus, which were handled quite poorly. And so by putting in place a system, as was done, it immediately brought up questions about whether there would be a bank run in Spain and some of these other issues. There wasn't. So there has to be some information there. The fact that whatever acronyms the ECB has put in place, OMT, LTRO, for the near term, they seem to be working. In terms of U.S. fiscal policy, the big risk with the fiscal cliff is passed, and we think what's going on in Washington today will also result in an outcome which, while not pretty, will be adequate for risk-taking. And even on oil prices, the unrest we've seen in some areas of the globe this year has not caused the same spike in oil prices as it did 2 years ago. So China, the euro, the fiscal cliff, oil, a lot of these big risks are ebbing. And so we believe this is creating an inflection point in the economy. And the questions I get now when I'm talking to clients are generally about upside surprises. So fracking, energy policy, 3D printing, smart manufacturing, big data, graphene, electric cars, cars that drive themselves, healthcare. These are the type of things people want to talk about now. And I think that's indicative of a shift, and it's important. And this is why it's important to get the regulatory structure correct. So I'm going to show you a few slides that do talk about some things that were mentioned this morning, pent-up demand. If we get the regulatory structure correct, there's plenty of liquidity in the system to allow this to play out. So my first slide will talk about where we are in the business cycle. So our view is there are 3 periods to look at that could be similar to today. And they're roughly 1986, 1996, and 2006. So the economy in the distant past was more volatile, but in recent times we've had periods where you've had slowdowns in the U.S. economy. Those slowdowns did not turn into recession, and you came back and lifted after that. Think about where we have been. Over the past 18 months, we've seen legitimate downturns, recessions in Japan, in the UK, in the euro area. We've seen a slowdown in the US. We've had some slowdown in China. We think we're on the other side of that. We think we're lifting like we lifted in 1986, 1996, or 2006. Now the challenge is, in 2 of these cases, the lift lasted 4 years. So in the 1986 period and 1996 period, that bounce lasted 4 years long. In 2006, it lasted 1 year. In other words, there are some different outcomes that we think are tied to productivity. And so the reason we think getting the regulatory structure is so correct is so important is that the drivers of productivity that were there in the 80s and 90s helped the economy to go much longer in terms of expansion rather than 2006 where you fell quite quickly and quite dramatically. And so the first year is the same. In all of these cases, you get the bounce. I would say even in really terrible periods like the Depression, you're able to get a bounce. We mentioned the 30s earlier this morning. Around 1934, you were able to get a bounce. It's just not sustainable if you are not able to translate the business cycle from recovery into expansion. Or we'd argue any business cycle after a downturn, like what we've seen over the past 18 months, should see a bounce. To get that bounce, that recovery, to turn into an expansion, it requires some additional work. So the bounce today, we think, is coming from 3 sectors: CapEx, housing, and state and local governments. These are the areas that others have identified where there is pent-up demand. I would agree with that. We look at non-defense capital goods shipments, ex-aircraft, as a measure of capital spending on a monthly basis. We take out aircraft because it's volatile, as others do, and this series has flattened out over the past few years. This is in contrast to what's happened with employment. So if these two series were consistent, and historically they're quite correlated, at least we would be able to offer an explanation. But what we've had for the past year is a very strange situation where you've had job growth that's continued. Could it be better? Probably. But job growth that's continued and has been positive, contrasted with capital spending, it's been very weak. So I could explain the opposite of this more easily. In other words, if I had good capital spending and weak employment, say maybe that's some sort of labor-saving technology, that's a theme that could be happening. This is like we suddenly decided each computer needs 2 people, something that just makes no sense. And so it's clear that business confidence has been depressed, and we think that's the inflection point we're at right now. And so it really would be some sort of self-inflicted wound, to replicate that phrase, to not get the regulatory policy correct at this point when it looks like a lot of other things are lifting and some of the big macro risks, oil, China, Europe, the fiscal cliff, are passing. We would also, when we look at the housing sector, see pent-up demand there. We've seen presentations earlier about how we have not had the housing construction and household formation over the past few years. This has been in part due to the bubble that burst, but this is an area that we think will drive growth in the near term as well. And so to put this together, we would use an old economic property, which is that business cycles are supposed to be symmetric. So there are economists like Victor Zarnowitz, who talked about this, came up with rules of thumb, such as the faster you fall, the faster you bounce back. That's supposed to work. And so the shapes you usually use to talk about business cycles are things like V's or U's. So a V is a sharp recovery, a U is a sloppy recovery, but there's an inherent symmetry. There's a balance to the entire discussion. That balance, that symmetry, is the faster you fall, the faster you bounce back. Now, it didn't work. It didn't work for all the reasons that were mentioned earlier in the past 5 years. But we would argue a lot of what we've talked about can still help the economy as we go forward. The household formation that has not happened can come back. The unemployment rate can continue to decline, and we'd argue that's a reasonable base case. The unemployment rate in the U.S. very rarely goes sideways. So if we look at the history of the data, very rarely do we find periods where we're adding precisely the right number of jobs to match all the new college graduates. It doesn't work that way. Unemployment tends to go way up in recessions and then spend the rest of the business cycle coming down. And we're finally getting back to more normal levels of unemployment. Could it be better? Yes. But the unemployment rate got to 10% in the U.S. during this downturn. That's very high. The post-war peak in unemployment was 10.8% in November and December of 1982. The last time we went above that, we have to start thinking about the Depression. We went to 25. And so it's rational for people to have been very scared over the past 5 years. The unemployment rate got to a double-digit number. As that is changing, we think some of these other pent-up items in the economy, capital spending, housing, and what's gone on with state and local governments as well, will stabilize and will turn back up. And so it's coming in an environment where we think monetary policy can remain broadly accommodative. We saw a lot of estimates earlier about how the Fed can remain on hold, whether they do more QE, do less QE. May not matter as much as long as we don't have an inflation scare. And if we look at the inflation picture, if we look at the wage picture, it's very hard to get too worried about inflation. If anything, there's been more worry about deflation in the current regime. And so in this type of environment, monetary policy should be the economy's friend, should continue to be the economy's friend, and we think that'll happen. It's unemployment that we have to continue to bring down. And so this is where we would see the upside potential as we get this cyclical lift. Recovery is pretty easy to get. Even in Japan, over the past 20 years, you've had about half a dozen rallies in the market of 60% or more. So even in quite poor regimes, even in quite bad times like the Depression, you tend to get a bounce. And the unemployment rate can still come down to more normal levels in our view. There's still room to go for policy to help. What we can't do is have regulatory policy intercept what is finally working on the monetary policy side. Now, part of the challenge is that as the economy's evolved over the past 5 years, we've taken the labor share of GDP, of income, down to very low levels, to record low levels. This is corporate compensation as a share of corporate GDP. And What we see is in the periods we thought this was similar to, 1986, 1996, and 2006, this labor share starts to turn up. And that's not a bad thing. It's just typical of a maturing business cycle. To elongate the cycle, to keep growth going in this type of environment, you tend to need to introduce new sources of productivity, tend to need to introduce exogenous events like financial innovation in the 80s, tech innovation in the 90s. I would argue the problem with 2006 is it was unproductive investment. In other words, what we introduced wasn't like the prior 2 decades because it led to unproductive investment. So the cycle was shorter. You still got the bounce, but to keep it going, you need productive investment. And that's why I think I'm getting so many questions on all of these items that are new. The focus is on Silicon Valley or these type of areas. Can we duplicate the productivity growth that we've seen in past decades? And this is why I'd say we need to get the incentives right, and now is the time. We need to get financial oversight correct because there are a lot of good things happening in the economy, and monetary policy has been very accommodative. Now we have to let it play out. Thank you.
Thank you very much, Don, and thanks to all the panel. The moderator moderating least does not include the right to ask the first question. The theme that goes through this panel and indeed the panels in the morning is that we have a regulatory regime that is broken, that it either regulates the wrong things, incentivizes the wrong things, or has contributed as much or more to the financial crisis and the slow recovery from it. In 1 minute or less, what single thing would each of you change about the regulatory structure in terms of power over the economy or power over institutions? And I'll start with Harvey.
It comes down to getting the incentives right and having competition. In the midst of the crisis, competition was reduced. There was no alternative because the only ones who could absorb some of the giant financial firms were other giant financial firms. The concentration increased. But the issue of perverse incentives and removing too big to fail has to be addressed. The Dallas Fed plan does that. It's one of many other plans out there. Dodd-Frank also supposedly does that, but I think all it does is entrench too big to fail. But I think what needs to be done with Dodd-Frank is it needs to be simplified and codified very, very quickly. So I think that combination of things would do it. Now, you have to look at the alternative of not doing it. You mentioned the word radical before. I'm not sure if you were saying I was radical. I don't think I am, and I don't think the Dallas Fed plan is at all radical. What was truly radical was quasi-nationalizing the largest financial institutions and a lot of smaller ones as well in the midst of the financial crisis. That is truly radical when the bastion of capitalism for the rest of the world has to nationalize its financial institutions. The only way out of that is to make sure that market incentives can do what they are supposed to do. Will markets work perfectly? No, but they can work better than they have been allowed to.
Thanks. Steve?
Tom, that was a really hard question. I really don't know.
Okay.
I don't know.
All right. Fair enough. Don?
I might just offer one thought, which is in terms of what principle we should be aiming for, I think that should be some sort of transparency. In other words, I think part of the problem with the financial crisis was you were allowed to hide so many different exercises off-balance sheet vehicles, so people like Stephen couldn't find it when you were looking at banks. The analysts who look at banks don't have the right information. They just have a black box that looks like it does something quarter after quarter after quarter, and that's how people model it. And so if I were to offer a principle-based approach, it would be that anything that looks like a loan should be disclosed somewhere.
Okay, thank you. And I'll turn to the audience for questions. Anybody out there with a question? Sure, go ahead. As soon as the microphone comes.
Harvey, I got a question. I mean, the Dallas plan. Is it credible? I mean, it doesn't work unless it's credible. And leads me to suspect that there might be a problem is that in the last crisis, the shadow banks fit all the criteria you just described, it seemed to me, for the most part. They weren't covered by FDIC until we gave them that. They weren't protected. Their depositors were well aware of the risks they were taking. The problem was they were still too big to fail. And if they're too big to fail, it seems to me they're just too big. And they know they're too big to fail. And what promises or how strict you want to be, once they realize they're too big to fail, they've got the protection. How do you make the plan credible? How do you, unless the plan hopes to make sure they just don't get too big to fail. And if they do reach that level, somehow you got to get them back down to a more manageable size.
So I agree with you that shadow banking is an issue. A lot of the shadow banking is right there in the regulated banking sector. So what my plan, I think, addresses is putting the safety net clearly under banks. All those banks then are of a size and complexity and systemic footprint that are too small to save. All the rest, everybody has had to sign off and say, I get it, I am exposed, and that begins to shift the mentality of, oh, these folks are no longer too big to fail, and I'm exposed over here. Maybe market forces would be ready to work and provide some of the discipline that has been missing. If I were to do a schematic of how the financial crisis evolved, it started in the shadow banking sector, spread to the too big to fail banks, who slowed down economic growth so that the crisis spread to the smaller banks. But it started in shadow banking. I was there in Jackson Hole when Paul McCulley stood up and almost sucked the oxygen out of the room by mentioning the phrase shadow banking. Everybody said, God, how come I didn't think of a clever term like that first? But shadow banking is not new. It didn't start with Paul McCulley's mentioning the term. We used to call them near banks, non-bank banks, and if you go back to the formation of the Federal Reserve, we had J.P. Morgan himself having to deal with the shadow banks, the trust companies at the time in 1907, and he had to deal with it the same way that the New York Fed dealt with long-term capital management, a shadow bank, and try to deal with the financial crisis in 2008 by trying to get all the principals into one room and try and say the room is locked and nobody's going home until we come up with a solution. So these problems have been around for a long time. Shadow banking is not new. Shadow banking is going to tend to explode every once in a while, but the issue is, do we want to perpetuate it by having a business model that is subsidized, that has that government guarantee under it, where you're adding more perverse incentives to the few that are already out there? And again, competition ought to be able to limit some of this stuff. Will it work perfectly? Absolutely not. We've had recurring crises throughout capitalism's history. We will continue to have them, but the issue is, should government policy be fostering more crises? And my answer to that is no, and let's begin to address it in a way that develops some credibility and changes those incentives.
Paul.
I think this will be for Harvey. When I look back at the modern day core of the shadow banking system, it's the 287 money market fund, which is regulated by the SEC and is given accounting treatment to always trade at the buck, and has become totally unambiguously embedded into the institutional financial structure of our country. It's dominated by 5 firms, which have some 80% of the $3 trillion of assets. And Mary Shapiro, bless her heart, tried her absolute best to convince Washington that a money market fund that trades at the buck, that's engaged in maturity transformation as a bank and should have capital or should be floated at NAV, and got nowhere. is there room for optimism on the Dallas plan if we can't do the most elemental, simple thing, which is to change 2A7 money market funds?
The Dallas Fed plan cannot do it all. But again, I think what it does is makes everybody wake up and think about the counterparty risk that they have every day as an individual or as a business. Signing an agreement that says, yeah, I understand I can lose money, then I think gets people to have a few sleepless nights and begin to wonder about it. And then the issue is, can they influence the legislators to try to create to remove some of these instabilities that we know are plaguing our system? I don't know the answer to that. The short answer is we send people to Washington because we want them to make our government function better. What we've witnessed in the last few weeks is people doing the very opposite. So in that sense, I'm getting old and cynical, just like you are, Paul, and I'm no longer have this bright optimism that everybody's going to get everything right. But nobody can ever get everything perfect. If you can get a few more things right and start moving in the right direction, I think, we might have market forces then reinforcing those first steps and moving in the direction I would like to see. Am I optimistic that it will happen? I think a few things will happen. I can't help but think that the view of too big to fail as having been fixed by Dodd-Frank is a view that's a couple of years old. Earlier this year, several leading Federal Reserve officials were saying, yeah, Dodd-Frank kind of has it right and it's not an issue. But I can't help but notice that with a little bit of pressure from some people in Congress on both sides of the aisle, that story has changed and changed dramatically in the last few months. That much more has to be done, a willingness to consider alternatives to Dodd-Frank, a recognition that Dodd-Frank is entrenching the forces that it was meant to undermine. And I think that in the next couple of years, maybe something will be done. I'd like to be optimistic about it.
Steve, did you want to jump in on money market funds or the prospects for better regulation?
Both.
Okay, fire away.
So since it's my role to scare everybody, I'm going to ask everybody to go back to the week in 2008 in October that Lehman failed. And on Tuesday, the reserve fund failed. So first we had a company highly levered and bust, and the investors, both bond and stocks, were asleep. That was Lehman. When the reserve fund failed, it was a classic bad shot run on the bank. People said, oh my God. And there's a $60 billion fund, and I got a phone call in the afternoon from a buddy that said, hey Steve, there's a bid list for $40 billion. And I said, no, you got the units wrong. It's like 4. He says, no, it's 40. So a $60 billion money market fund should be money in the bank, should be able to get it. 40 billion of withdrawals that afternoon. So it's a classic run on the bank. Now go to the end of the week. AIG calls up and says we need 10 billion. They call up the next day and say we need 85 billion. So here's a global AAA company that was way too big to govern, even by a guy who knew everything about insurance and banking and built the company in his wealth, Hank Greenberg. And it blows up because of a group in London, probably smaller than 1/2 of this side of the room. So I look at this as a systems problem, and I think there was one line in Harvey's chart that said too small to save. These are just complex things, and you have to be too small to save, because the minute the trust is gone, the minute, all of you here that work in securities, you know what fail means. The minute you fail to deliver, it's over. And so I think we locked up that week when the money, I was at meetings where, and Paul was in them, where people coming in and GE Capital's calling and saying, if you don't do something by the end of the week, we're dead. Why? Because their overnight funding went away. So I think it's a systems problem. And to say that the Dallas Fed solution is going to solve it isn't the issue. The issue is if it's a good step forward that makes better incentives, that makes the system better, and keeps the system from breaking, which is the beginning of my talk, is the system broken.
How about you, Don? Do you want to jump in on the money market fund and regulation issue?
I guess the only thing I could add is to say that if we get a few things right now, I think we can buy ourselves more time. I think the economy is in a position where if we do a few things right, there's pent-up demand in the economy that will give us time to get more things right. It's not the emergency that we had a few years ago, but we have to take advantage of this time where it's not an emergency to make those changes.
Is it possible, though, that we're in the period where you don't have to fix the roof because it's not raining?
Well, I guess I'd say we could go that route. I hope we don't.
On the other hand, it may rain very seriously in Washington shortly. One more question, if there's anyone out there. Otherwise, pass it back to Dave. Going once, going twice. Thank you very much. Thanks to the panel.
Thank you, panel. Thank you, Harvey, Don, Steve, and Tom. The grand finale summary of the day's activities will be delivered by someone who is older than I am. How many days? Now, I've known Bill Dunkelberg for how many years? How many years? I don't know. A lot. A lot, he says.
20 years anyway.
At least 20 years. And I never let him forget that he's 10 days older than I am. And we have become longtime, very good friends, and he has been my mentor over all of these years. So I need to tell you a story, which I have his permission to do. I had a meeting in my office not too long ago, and some here have heard this story, in which case I say, please indulge. And there are 5 other people. We're sitting around a coffee table, and we're sitting and talking and talking and sitting and sitting and talking and talking and sitting. Now, when you get over 50, as some in this room know, there are certain things which require that you stop sitting and talking. So finally, after 3 hours, I said, we need a 5-minute break. I need to go to the men's room. Of course, everybody else had to go too, so we take a break, we get up, we reconvene in 10 minutes, and here we are sitting, and I look down, and my fly is open. Now, what do you do if you're a man in such a circumstances at an open coffee table and your fly is open? You're sitting there, you have a nice blue pinstripe suit, and your fly is open. Well, I'll tell you what you do. The first thing you do is you put your knees together so you can hold your pants. The second thing you do is you take the pad or book or whatever you're taking notes on, and you put it in your lap with one hand, and very surreptitiously you reach underneath the pad with your other hand, holding your pants together with your knees, and you zipper up your fly. So after the meeting is over, I'm talking to my mentor, brother, friend here. And I said, Bill, I have to tell you, I'm really getting old, and that means both of us are getting old, even though you're older. And he says, why? So I tell him what happened and the meeting, and I go to the bathroom. I come back with the knees, with the pad and the fly. I said, I forgot to zip up my fly. And he says, when you get old, like me, you forget to zip it down. Bill Dunkelberg. You wrap and close, okay?
Thank you, David. I can honestly say that of all the introductions I've had, yours is definitely the most recent. So actually, this is a real prize spot. I'm very honored to have this spot because you'll notice I'm the only speaker without a stop time. I start at 2:45, and that's, we might want to tell people about what we really have, what do we have to get done? 3 o'clock. 3 o'clock?
Or whatever
Yeah. Well, you know, professors are geared up to do at least an hour at a time. But 3 o'clock will work for me. I have to say that I go to conferences a lot and I speak a lot, and I usually don't listen to what's going on, but this was an exceptionally powerful set of presentations we had today. It covered a lot of very important material, raised a lot of very important questions, and I'm not going to be able to do them justice, I think, but I will make a few observations. I tried to write them down on my computer as I'm going along. So we'll see what I can come up with here. So using the boat analogy out there, all these sailboats going, we started 2003 as kind of a new growth race. We gassed up our boat with a new fuel called leverage, lots of leverage, right? And unfortunately, we picked up a lot of speed, went off course, hit a storm, right? It was a really bad storm. And we tried to use our traditional instruments to figure out where we were and to get back on course, and they obviously haven't been working very well. And we had a very good discussion of that today. So we then started trying different techniques, untested ways to get our boat back on track and to get into waters that we understood and could navigate. And it's pretty clear that they haven't been working as well as we hoped. Paul made a great observation, said, well, you know, you can't expect them to work that quickly, so it's going to take time, so we may be calmed for a while or be blown the wrong way, but eventually we'll probably get there. So the focus, of course, has been on Fed policy. A lot of the discussion has really been about Fed policy rather than fiscal policy, and on interest rates. And I would just remind us all that interest rates are indeed in the denominator of the valuation equation, but there's a numerator. And its movement can overwhelm the impact of changes in the denominator. And I think that's exactly what's been going on. The numerator is driven by expectations based in part on past performance, so we talked about models and how well those worked, but mostly by weighting of expected outcomes. That's the way we kind of look at the future, and we value things by looking at what we think the numerator will do going forward, not necessarily on what it did in the past. And of course, we make those forecasts, we adjust them for all the uncertainty there might be, so there are probabilities involved here. And of course, and I think that uncertainty is right now remarkably high. There have been some interesting papers written about uncertainty, and in the surveys that I do of the National Federation of Independents, 350,000 members, we ask a lot of questions, and there's always a choice in the thing, you know, better, worse, don't know, or uncertain. And we've seen those uncertain, that is, people can't even give us a directional forecast on where they think the economy is going to go. We've seen those hit record high, 40-year record high levels over in the past 12 months. So there's a lot of uncertainty out there, and that's certainly impacting the numerator of our valuation equations in terms of deciding, you know, what we should be doing and where we should be putting money. So we got a lot of good examples of why incentives really matter, and government certainly has control over very important incentives such as taxes and interest rates, and many other important prices, including minimum wages and these kinds of things. These incentives are continually being changed, sometimes in an attempt to do good things. You know, Barney Frank's goal was to get us all into affordable housing. He was unsuccessful at that, so he did get us into unaffordable housing, but it was, you know, maybe well-intended. Also, sometimes these are done in an attempt to, my computer just went out on me, to get votes and to fatten our, well, got onto the internet there for a moment, and to fatten our campaign funds. And so we've certainly seen a lot of that happening as well. It is amazing to me how many members of Congress and high-level officials leave Washington with so much wealth that you couldn't possibly predict them accumulating by looking at the salaries that we pay them there. So something's going on, but anyway, that'll be the subject of another talk sometime. So fiscal policy we see is really trapped in the political shoals, if I might continue the analogy, of the sea we have to navigate. We have a few hundred people in Washington, most of whom I think probably never had a real job, who are busy restructuring huge chunks of GDP in the financial sector. And so we had good discussions about Dodd-Frank and, You know, do these people really understand what they're trying to do? And of course, we know that they don't read the bills before they vote on them anyway. They just say, what's this bill supposed to do? And you tell them it's supposed to make things better, and they go, great. If I don't have to read 2,600 pages, I'm going to vote for that. And that's what we get. And then, of course, it all has to be implemented over time, and that takes a lot of interesting effort. So the Fed, of course, tried to pick up the baton that we seem to drop here on the policy side. We got QE, and certainly QE was very, very interesting. As one person, I've forgotten who said that, now it's really just the same stuff we always do. It's buying and selling securities. We're just doing a lot of buying, not much selling, but nonetheless, the mechanism was pretty much the same. In any event, the hopeful goal of the QE was, once we had kind of stabilized the system and made sure that we didn't have runs on the bank, and that's the main job that the Fed has to do, is make sure the banking system works. And so I think the early on stages, the first QE did a good job of that. But as we moved on, the hope was that QE, providing all this liquidity and at very low interest rates, would induce the private sector to go out and expand and buy equipment and hire new people and so on. And that would raise GDP and employment in the economy. But instead, it looks like we took all that liquidity and just bought financial assets. So we have record high stock market prices, stock prices and gold prices. And so we had a lot of that going on, which didn't really do a lot for GDP. I think Paul pointed out it did a lot to distort the distribution of income further, so that like 90% of the income gains that we had in the last 12 months went to the top 1% of the income distribution. Why? Well, because they own all the stocks and bonds that have been supported by the QE. Yeah, they spent some more money, but not enough more to really move things forward. Now, looking at my half of the economy, the small business sector, which I follow very carefully, what we needed, of course, was to have middle and low income people getting higher incomes and jobs, so they would come into our stores and buy stuff, and then we would order more inventory and hire new workers, none of which, of course, we have done. So as far as we can see, the small business sector, which is half of GDP in normal times, half of private GDP, is stalled. It's growing at kind of zero. The big half of the economy has been doing very well, driven, as you know, by a lot of foreign trade, lots of profit. More, a lot of the companies make more overseas than they do here, so a lot of foreign trade. So that sector's been doing well. So my simple analogy is 0% growth for one half and 4% for the other half, divided by 2 is 2. And 2% is the kind of growth we have seen, and all the evidence that we get from our monthly surveys says that the small business sector is just not ready to grow yet, and it's not going to really contribute to the progress that we need to make. We're going to be slugging it out for some time. So as I mentioned, uncertainty is very large. Certainly for fiscal policy, we don't know what's really going to be happening there. And we're not sure what the Fed is going to do with $4 trillion in assets. We assume they'll at least keep $1 trillion because that's what we started with. We look at, of course, the liability side of the Fed, and we see we're headed towards $3 trillion in excess reserves. And it's true that as I speak to bankers across the country, from the California bankers to the Jersey bankers, all the bank officers tell me the same thing. We have money to lend, we just don't have customers that want the money. And that makes sense if you look at certainly the small business stuff that we do. You'll see that people are very uncertain about where the economy is going to go. They're actually pretty soured on where we think the economy will go. More think it's going to be worse in 6 months than better, et cetera, et cetera. So with that kind of a view, these people aren't going to borrow money. That is, if you're going to borrow money, you have to put it to work in some kind of an endeavor that promises to give you enough cash back to at least repay the loan. That's what we expect them to do. And right now we don't have it. So in our surveys, about two-thirds of the firms say they have no interest in a loan. So we think that, and I am chairman of a little bank and would like to see more customers, we think at the bank and based on my data and my conversation with a lot of the bankers, that the people we really like to lend to are sitting on the sidelines, waiting for some of this uncertainty to resolve itself so that they can get a better picture of, if you will, of the numerator, that is, where things are going to go, so they can figure out how to value various activities that they can become engaged in. So that's so uncertainty is really, I think, a killer here for us, and until we see that get resolved a little bit more, it's going to be tough. So, what will the Fed do and what will Congress do? Those are big questions for us. These are the major uncertainties for the private sector. We also see huge growth in the regulatory tax. It seems to be growing. It's a very insidious allocator of resources. So one has to pay close attention to what's going on here, because it's a bunch of huge amounts of our resources are being allocated by regulators, not even people elected officials, but just regulators who tell you not only take our money through the tax system, but tell us how to use our money, and we're not sure that a lot of that's very productive. So we'll have to see. We would much prefer, of course, having private markets allocate those resources. So I think the fundamentals will still drive us forward, as Paul pointed out. We do have 3 million more people in the economy every year. That's 3 million more haircuts, more cars, some housing. We need that, and it's a lucky thing that we have that, because if you look around Europe or Japan, they don't have that kind of guaranteed 1% growth in demand that you're going to have by having the kind of population growth we have. So as long as that stays up, that's certainly going to help us. I think the private sector will just continue to push forward, regardless of the roadblocks that we see Washington put in place. They're going to, that's what the U.S. private sector does, and so the issue is not whether or not we'll grow. We will grow. The question is, how quickly can we grow, and how will we adjust these regulatory prices that can either shade growth lower if it gives us the incentive to use resources more poorly, or we can grow faster if we get the incentive to use them more efficiently. One example that we see now that we're dealing with, of course, is the Health Care Act. Last June was the beginning of the so-called counting period to determine how many full-time employees you had and how many part-time, in preparation for finding out how much, whether or not you had to provide insurance, whether you're over the 50 mark, and so on and so forth. And if you go back and look at the June numbers, you'll see that we created 360,000 new part-time jobs and gave up 240,000 full-time jobs in the household survey. No surprise, the aggregate hours, if you multiply it out, kind of come out to be the same. But of course, that's a very inefficient way for firms to operate. If I have to manage 2 people to do the work that one person could have done, one full-time person, it's not a very, very good outcome. These are the kinds of incentives that have been set up, and that will certainly make us, I think, operate more inefficiently rather than more efficiently. So that's going to really shape how quickly the economy, I think, recovers. And of course, recovery is what we really need, because the burden of a lot of the regulatory stuff that we face is lightened, if you will, if productivity or the value added per worker can be increased. So I can pay, for example, a higher minimum wage to a worker if that worker is shoving a lot more hamburgers out of the window per hour than they're doing in a recession. So I can handle those kinds of things if we can figure out how to get growth started. But if the policies are going to suppress our growth and slow it down, then obviously we can't handle the regulatory costs that are going to be impounded on us. So I think Paul again pointed out, time is what we need. Time will heal our wounds, and we need time, and it'll happen very slowly. What we hope is that along the way we don't inflict even more new wounds that continue to cause bleeding, misallocation of resources, misdirection of our decision making, and we'll have to see where that takes us. So we're all cheering for that, and I assume we're letting our regulators and legislators know what we think they should be doing. So I'll stop with that, and I don't even have a Q&A period. People might ask me a question. David says I can have a Q&A, or let me open the floor for you to just make your observation about what you've learned, and we'll take a couple of those. What did you get out of, what did you hear? They weren't ready for that, see, so the microphones weren't out. What did you hear? What's your takeaway from the conference? And of course, being a good professor, I can make up answers to any question, so feel free to... Nobody. Oh, there we go. I mean, I can't believe that this group doesn't have strong opinions and views.
Bill, you made a comment about just banks in general have money they want to lend, they don't have customers to lend it to, and that there's various activities that are hard to measure. Don't you think keeping short-term interest rates at zero or near zero makes that problematic going into the future? In other words, if you had some short-term rate, albeit 1%, 0.75%, whatever, your compare and contrast activity suddenly becomes a little more clear.
Well, yeah, I agree with that. In general, I've been of the opinion we'd be better off if we started raising short-term rates, just as to convince the markets that we're moving back toward normality. Whatever it is, we don't have to define what, but at least letting markets set prices rather than having the Fed set the one of the most important prices that we have to allocate resources, and that's the interest rate. The Fed, of course, has made the funds very cheap. It's actually a stated part of policy that the current QE policy helps to recapitalize these large, too-big-to-fail banks. They're making a lot of money. My little bank, of course, can't play the same game with the 12 basis point overnight funds. We can't do that. In fact, most of the banks I talk to have floors in, so the Fed can't really lower the lending cost any further for all these 6 million small businesses in the U.S. because we really can't make loans really cheaply. So most of the floors that I hear about are like 4.5% to 5%. So we'll go as low as we can. But so at our bank, we'll still give you a home equity line of credit at 1 point below prime, but the floor will be 5. So if prime ever gets up there again, you can have 1 point, you could be a good customer risk for 1 point below. So I think that's really the issue. We know the funds are all there. I had kind of an ongoing controversy in the press and at conferences with Chairman Bernanke and Treasury officials who kept saying that the banks, that one reason the economy was recovering so slowly was that banks would not make loans to credit-worthy customers. Now, my first question to Chairman Bernanke was, well, how do you know? What loan committee do you sit on that you notice that we're turning down good business? We don't prefer 25 basis points to a good 6% business loan. We would like to make them, but the NFIB data, of course, support that. These people are not interested in getting a loan because they don't see a way to use the money to generate a cash flow to repay the loan. They have a bad view about where the future's going to go, and that's where we're stuck. So one of the best things that could happen is that Congress and the President get together and do something that all of us could say, yeah, it's still going to be tough, it's going to be slow, but it'll be a track that takes us to a more sensible place in life. And therefore, I have more confidence about the future, and I'll go ahead and spend some money. 25% of our owners said that it's a bad time to expand their business because of the political climate. That's what they say, the number one reason why they don't want to expand their business. Well, if we could just fix that piece, I would get a lot more firms spending money, investing capital, doing more than fix the roof, and that would certainly help move the economy forward. And that's what we really need to have happen.
I think you asked a question, basically, what do some of the people in the audience learn? And I would say, coming from a perspective in small Bermuda, where we've suffered greatly recently with the shrinkage in our economy, I come here to listen and learn tremendous information, certainly from the gentleman that is going out in the desert now and questioning everything the Chicago School of Economics says. And I think that on the other hand, one of your speakers said, just be patient, wait. Everything's hovering around 2% as far as growth and inflation. And then I hear from other speakers an optimism of crafting new philosophies of looking at the large banks and whether there's a smart way of basically taking it apart almost like a liberty ship so that your financial system could be protected, so if some small sector of banking is having a problem, at least it doesn't destroy the whole national or international banking system. And that the hard question is, how do you set about dismantling that in a constructive way that doesn't harm the recovery? That's what I learned today.
contagion is a tough thing to manage. And that, of course, is really the concern we have, all the way from how it represents itself as runs on banks to just our fear about the future, so that we stop doing things that would normally be good things, like hiring and investing in real capital, which raises worker productivity. And so, yeah, you're exactly right. One more back there, and then I'll turn it back over to my junior partner, 10 days junior.
So Dunk, is there any risk of sitting on the sidelines and uncertainty becomes the new normal?
Well, that's a good question, and we talk about that. People look at my data and say, is this a new normal? And I say, no, let's go back to the speakers who basically concluded what I think is right, is that we really are suffering from weak demand. So I don't think we're stuck with this. We really need to refire consumer spending. If you look at the data we have, especially on services sector consumption in the U.S., very, very weak, and that's the very labor-intensive part of the economy. It's also true that even though we're making more GDP in the U.S. today than we did in 2007, we are using 2 million fewer workers to do that. Measurably, you could call that an improvement in productivity, but really what it is, as a couple of speakers pointed out, is that we're missing a couple 100,000 housing starts from the GDP numbers. We're still way off pace where we kind of ought to be on a trend basis based on household formation and demographics. So we'll have to put that back, and that'll come slowly as well. That's really, again, a demand problem. The reason GDP is higher is because, of course, we did a great job overseas. Caterpillar and GE were great stocks, and they've done very well. And we're selling stuff around the world. How long that'll hold up, we hope it continues to. So I think that's an aggregate demand problem as well. Now, we do have some interesting labor force things going on where there are a bunch of old people like David and I who are retiring. And so, we're not going to be putting stuff on the pile. We aren't going to be making GDP like we used to. So there are some structural issues that could, in a sense, for the next 10 years, have a dampening effect on our potential growth rate. But I think those can be far overcome if we could just get some sensible policies out of Washington and restore normalcy. So thank you all very much. I'll turn it back over to David.
Coffee starts at 9 o'clock tomorrow morning, and tomorrow we're going to talk about city, state, and local government debt, credit or not. And that concludes our program for today. We have some empty seats tomorrow. If you want to bring some folks with you, see Jill, and we'll make room for that. See you tomorrow morning.